Last week was a really interesting week. It was shortened for both the US stock market and the Canadian stock market on different days. The real clue to what could be coming up for the stock markets took place on Canada Day when the Canadian stock market was closed and the US stock market was open. It was the first trading day of July for the US stock market, and there was a lot of stuff going on that could be revealing what's happening on the inner workings of the market. Okay, so if we take a look at this chart here, this is for Tuesday, July 1st only. And this is for the S&P 500 major sectors. Here's the S&P 500 just down slightly. The materials sector up 2.6%. Now the materials sector has been lagging. So all of a sudden the sectors that weren't doing well seem to be doing well on this particular day. And we saw the consumer staples and healthcare were the next best performing sectors. Those were defensive sectors. If we take a look at the worst performing sectors, there was only two that were negative. That was communication services and technology. Look at technology, down 0.9%. So what we're seeing on a fairly risk-on day, when we saw a lot of the assets all of a sudden adjust upwards on the materials and some of the cyclicals, we saw the technology sector head lower. And that's not a good sign. So we're seeing investors rotate out of the sector that's been leading the market for quite some time. And that is, and when it happens at the beginning of the month, is often an indicator of investor sentiment. And so this could be something interesting to watch. If we see technology underperform on a consistent basis coming up shortly, that could be a sign that the market's about to roll over. Now, I say that, and there are some positive tendencies for the market. We will talk about that today as well. If we take a look at the major markets for Tuesday, July the 1st, obviously the Canadian stock market's closed. And if we take a look here, we can see that the NASDAQ was down 0.8% on a risk-on move. And what's interesting is the small caps, which really have been underperforming. This was like a risk-on move in certain sectors, and the sectors that weren't performing well, all of a sudden perform well. So the small caps outperformed strongly. It's interesting to note that Europe, once again, underperformed on that day. And Europe has been lagging the U.S. stock market. And we saw at the beginning of the year, Europe do really well as investors pulled their money out of the U.S. stock market and put it into some of the other markets around the world, including Europe. Now, the European economy is not doing well, but we've seen this shift take place due to reallocation away from the U.S. Emerging markets on that day actually did well as well. And this is Tuesday again, and if we take a look at the major sectors of the market, here's uranium. Uranium has been on fire, but on this big shift, it was really a shift of what was working didn't work on Tuesday. What wasn't working did work. So here's the home builder sector. Look at this, on 4.1%. I looked this up. There was no positive news for the sector at all. The sector really, we've just seen bad report after bad report after bad report come up for the home builder sector overall. And here it was one of the stronger sectors of the day. So this shows that it was a risk-on move. And that's usually when technology does well, and it didn't. And if we take a look, the retail sector, which also has been performing poorly, also performed well. So we're seeing that this was a really risk-on, knee-jerk reaction into the markets. But the big thing is the technology sector that we have to follow. Okay, this graph shows all of the different sectors of the market relative to the S&P 500 in the bottom panels. Here's the communication sector, flat. Here's the discretionary sector, flat. And here's the consumer staples sector, negative, underperforming. Here's the energy sector, and you can see here, other than a blip, it's been fairly flat. And here's the financial sector, a little bit of a tick up after pulling down. We're going to take a look at that in a minute. And then here you can see the healthcare sector, underperforming. And then if you take a look here at the industrial sector, the industrial sector has been performing well, but over the last little while, flat again. And here we can see the material sector underperforming the S&P 500. And this sector here is the real estate sector, and you can see it has been underperforming. Here's the technology sector, solid outperformance. Okay, so we've seen that sector really holding this market up. And if we take a look here at the utility sector, it's been underperforming. So there really has been just one sector that has performed well, and it has been the technology sector. It's holding up all these other flat sectors or negative underperforming sectors. So it's this, as investors have rushed back in this risk-on move from early April, we have seen the technology sector strongly outperform. But that indication on July 1st might be saying that maybe we've are coming up to some sort of topping process for the technology sector. Now I say that, and nobody likes me to say that. I mean, I get bad responses. Oh, the technology sector, you don't understand. It's going to keep going. It's it's going to change the world. Yeah, I get all that, but it can be overbought at certain times and can pull back. And in fact, we saw the technology sector underperform, if you take a look here, for quite some time, many months. And it's only recently in this risk-on move we've seen that take place, the outperformance. So this is the performance of the sectors, the major sectors of the stock market, the S&P 500 last week. So this is the total week we're talking about this week. Here was the S&P 500 up 1.7% for the week. Here's the material sector up 4%. So it really was a one-day gain on Tuesday, which was really interesting. It wasn't a continuation. A one-day pop for some of these sectors, consumer staples likewise, and healthcare as well. And look at this, the technology sector actually outperformed for the week. So it was just that one day, all of a sudden we saw, really for no reason other than a reallocation of assets that took place that dragged the technology sector down, but the technology sector outperformed for the whole week. So what's coming up this week for the stock market? It's going to be a really interesting week. There's not a lot of economic news coming out in the U.S. market. I think the market's really going to start to wait for the following week when we see the bank earnings come out. We'll talk about that in a second. But if we take a look at some of the reports that people will be watching, we will be watching for the mortgage applications, which is part of that home builder sector as well. Here's the FOMC monthly minutes. So that's always a doozy to read. That might move the markets a little bit. In initial jobless claims as well, we saw a really strong non-farm payroll number last week. A lot of that had to do with the government hiring, though. And if we take a look at the ADP number that came out earlier in the week, it was actually quite weak. So we saw a big discrepancy for those numbers. Now, the ADP number does move around quite a bit. So does the non-farm payroll number. They keep revising it lower, so we'll have to see what happens as well. But not a really busy week for U.S. news. I think the big thing this week is going to be, for the Canadian stock market, is going to take place on later in the week, where we get the unemployment rate coming out, and we take a look at some of the hourly wages, etc. So last week we saw the U.S. Shift their non-farm payroll and unemployment report from Friday to Thursday. Canada didn't do that, and they'll be releasing those results this week. So, but it's not a big week for the economic reports. I think what we're going to probably see this week is we're probably going to see a little bit of a pause or towards the end of the week as investors really anticipate the start of the Q2 earnings season, the unofficial start of it, which is the U.S. financials. If you take a look at the following week, early in the week, we see the Bank of New York, BlackRock, Citigroup, JP Morgan, State Street, Wells Fargo. We just keep going down the list. Bank of America going here, M&T Bank Corporation as well. I mean, these are all the banks that are releasing early in the week, in the first couple of days of the following week. So we're starting on the 15th, starting to get some of these reports. I think that's what's really going to be, could have a big driving impact on the market. Okay, this graph shows the financial sector. I wanted to put that on because the bank earnings come up shortly, and you can see here that overall, this is relative to the S&P 500. You can see we have seen some strong performance for the sector relative to the S&P 500. We have seen a little bit of a breakdown recently on that as well, which is interesting. So we'll have to see if that goes down further. A little bit of an uptick here, but we have seen a breakdown of that overall trend. Now, on an absolute basis, the sector's actually broken above resistance here, which is a positive sign. I do want to say that here we are, we're starting to become overbought for the sector as well. And I'm going to talk a little bit about the financial sector next week for the weekly video. We'll look at some of the seasonality for the financial sector and what to expect coming up shortly for that sector. On a positive note, what we've seen is that Besant has said that they're going to delay the tariffs, which were supposed to start to take effect this week. And they're going to delay them till August the 1st. And I think we've heard this before, though. there's no deals reached, then we're going back to the April 2nd tariff levels, like we've been bouncing around a lot. But the big news is that they've been delayed here. And I think most investors at this point are just pushing off anything to do with the tariffs. They've had a little bit of tariff fatigue, and they say, well, it's going to be extended. There's been some deals starting to be signed with some of the Far East countries, but nothing like what Trump had expected at this time. And we are starting to see a delay, but this could help the market in a positive way. I've seen this chart being passed around a little bit. Here's the month of July for the S&P 500, and here's the average here. So it's a really strong month on average. And this is over the last 20 years. And you can see a lot of green for the S&P 500 in the month of July. We're going to talk a little bit about that here, and we do see some right here. But overall, over the last 20 years, the S&P 500 has done well in July. But there's more to the story. Okay, so here's the chart showing the month of July, and this is the last 20 years here, exactly what we just looked at on the heat map. So this orange line, you can see here that July really has peaked over the last 20 years for the S&P 500. Around the third week in July, and then we'd see on average a flat end of the month. Now, I've done some long-term studies on this, and if we take a look here, we can see that there's around the 15th tends to be the longer-term peak in the month of July. So this is from 1990. Let me just get a line here on that. So this is from 1990 to 2024, and you can see that 15th is really the top of the market on average in the month of July over the longer term. So we do see a little bit of a discrepancy taking place. In the shorter term, the last 20 years, we have seen this extra boost. Now, we've really been in a stock market where the technology sector has driven this higher. So a lot of this, I think, will depend on the performance of the technology sector. But if we go back to 1990 or go back to 1950 or back longer, we tend to find that the mid-month of July tends to be a top for the S&P 500, and then we tend to see some sort of leveling out of some sort. So why does the stock market tend to actually increase in the first half of the month? And that's because investors position themselves ahead of the Q2 earnings, anticipating that the earnings will push the market higher. And so you tend to find the stock market, it plays out by the stock market doing well as more and more investors take a position for that. And then once everybody's in, you tend to find that you tend to find over the longer term, at least, this much flatter performance in this area here. I want to show you this chart of the S&P 500 where we stand on a technical basis at this time, and take a look at the RSI and a possible signal that we should be following as far as seasonal and technical investors goes. So if you take a look at what's happened for the S&P 500 here, it's had a strong rally from April lows, and we can take a look back here. It's above the high that we saw in February, so it's reaching all-time highs. That's all positive. You can say nothing bad about that. I want to focus on the RSI here and take a look. Now, the way that it's often best to use the RSI on a seasonal basis is to take a look at the considerations in the seasonal period of either strength or weakness. Now, here we're in a period of seasonal weakness, so when the RSI is above this 70 level and then turns back below that 70 level, that is often an indicator that the market's about to turn lower. Whereas in the stronger period for the market, from October to May, that often doesn't hold true. So let me show you as an example. So let's go back to 2022, and here we saw the the RSI for the S&P 500 go above 70 and turn lower. That happened in August, and then we saw the stock market head lower here at this time period. And we go all the way across here. We can take a look here, and here we are in July, where we see that once again occur, and that put in a top for the S&P 500, and it headed lower. So that's when the RSI turned below 70 here. Now, I want to show you this example here. We saw the RSI go above 70, become overbought, and then go below. But look when that occurred. That occurred in December of 2023, and that's in that strong 6-month period. So it's not, to me, it's not really that valid of a signal from a seasonal point of view, because that's a strong period. And in fact, that we did see the stock market continue to move higher. And once again, the RSI went overbought in July of 2024, and when it turned below 70, guess what happened? We saw the S&P 500 head lower once again. And here you can see we're in this similar situation where the RSI has headed above 70. Now, maybe it doesn't turn down, maybe it does turn down a little bit, and it breaks this pattern that we've seen. But it's often an indicator in this time of the year that if we do start to see the price momentum decline, that the S&P 500 is about to roll over. Now, we have some strong seasonal tailwinds, at least for next week, maybe, or so, for the S&P 500. That's possible. But if this starts to happen, we could see the S&P 500 actually top out a little bit early. It's going to be an interesting week. Thank you very much for joining me today.